There's only one time I'd ever stop investing. And no, it's not because of a crash, inflation, or politics. If this one thing happens, I'm out. And if you're investing right now, you should be watching for it too. But first, let's back up a little bit. You see, people often assume the only time to stop investing is when the news gets scary, like when headlines scream about economic collapse, or when your uncle at the barbecue starts yelling, "The market's going to crash." That kind of noise has scared a lot of people out of building serious wealth. And here's the twist. Those people are almost always wrong. Why? Because they're making emotional decisions, not data-backed ones. There's only been 2 times in 25 years where I truly hit pause, and I lived through one of them. I'll show you what my system revealed before the crash and how I made money while others panicked. Now, I started investing just before the 2007 to 2009 financial crash. You remember that one. Banks collapsing, housing market in free fall, everyone hoarding toilet paper. Actually, okay, maybe that was a different crisis. During that time, however, the S&P 500 dropped over 50%. Half the market was wiped out. But here's the thing. Because I followed a proven system, I knew something was changing before the full crash happened. You see, I don't invest based on vibes, news anchors, or Reddit threads. I follow a trend-following system that uses 3 time frames: the monthly, the weekly, and the daily charts to objectively tell me when to buy, when to hold, and yes, when to stop investing. I've seen smart people lose everything because they listened to a headline, or worse, their gut. They sold at the bottom, bought back at the top, and repeated the cycle for years. Let me break it down. On the monthly time frame, we look for a clear uptrend in the S&P 500. This tells us we're in a bull market. But if it starts moving sideways, bouncing between 2 price levels, that's a warning sign. Momentum is slowing, a deeper shift could be coming. Then comes the weekly chart. Our proprietary trend filter turns green when we're in a healthy uptrend. That means prices above the 200-week simple moving average, and we're making higher highs and higher lows. Now, here's a pro tip for you. If that filter turns red and a price drops below the 200 simple moving average, well, we are entering a phase where the market is signaling a shift from bullish to bearish. And that is a little fact most people are unaware of. However, this shift in market structure is not something to fear. Far from it. It actually brings its own set of lucrative opportunities for clued up investors, which I'll explain shortly with a real-life example. But before we get into that, we must understand the daily chart. This is where things get surgical, where precision is needed. We want price to be above the 20-day and the 50-day simple moving averages with a green trend filter. On the daily time frame, if it slips below the 200-day simple moving average and the filter turns red while forming lower highs and lower lows, that's a signal of weakness. And now, when all 3 time frames align, that's the monthly, the weekly, and the daily, to signal bearish momentum, that's when I stop investing. But here's the thing, I don't really stop investing. In fact, far from it. With the tech and broker accounts available to us today, we can do something far savvier. First, I take profits and cut out from my long positions. But remember those lucrative opportunities I mentioned a moment ago and a real-life example? Here's the thing, my system gave me the signals that others just didn't see, prompting me to strategically position myself for a bear market and to profit on the way down by shorting it. Smart, right? When the market started declining in 2007, most people waited until it was too late or simply did not have the right game plan or understanding in place to profit from a declining market. Now, you might be thinking, wait, how accurate is this really? Well, let me show you what happened when I followed it. Monthly, momentum slowing. Weekly, price broke below the 200 weekly simple moving average. Trend filter, red. Daily time frame, declining. Trend filter, red. Lower lows forming. Now that was my cue. I stopped buying and tightened all my stop losses. While other investors were panicking and watching their profits tank, I stepped out. But I didn't stop taking positions completely. I switched strategies because when stocks fall, guess what? You can make money on the way down. Smart investors don't just buy, we also short. The 2007 to 2009 crash wasn't just chaos. It was one of the most profitable period for investors who knew how to play the downside. Fear spreads faster than greed, so when the market starts tanking, it drops fast. That opens up powerful shorting opportunities. And myself and my business partner took full advantage. If you've ever felt like you're always one step behind the market, this isn't your fault. You just don't have a framework, not as yet anyway. My system not only helped me avoid losses, it helped me make gains while others were getting crushed. I knew what to do, when to do it, and why. That confidence, it's everything. Then in mid-2009, something changed. The market reset. All three timeframes turned bullish again. That's when I re-entered my long positions. Not because of news, not because of some analyst or news anchor or finfluencer online saying, hey, we've hit the bottom, but because the system said it's time. So here's the big truth most investors miss. If your strategy is based on emotional responses, breaking news, or hunches, you'll lose money. But if it's based on structure, logic, and a trend-following system, you stay in control. If you're watching this and you're a beginner investor, maybe you're a busy professional, maybe you're running a business and trying to grow your wealth on the side, here's the truth. You don't need to master day trading. You don't need to beat the market. You need a process that helps you ride the trend when it's going up and protects you when it's not. That's what we teach inside our private community. We help investors like you ditch the noise, follow the trend, and become consistently profitable. The biggest transformation I've seen in my own journey, letting go of the need to predict the market and be right. I stopped chasing news headlines. I stopped reacting emotionally, and I started following a simple, proven approach that compounds wealth over time. The goal again isn't to be right, it's to make profit. These are fundamentally different mindsets. Those obsessed with being right often try to outsmart the market and end up failing, while those focused on profit aim to work in harmony with the market, where we are rewarded with compounded returns. It's the same transformation I see in our own members. They go from confused and overwhelmed to calm, confident, and consistent. I can't stress this enough. Successful investing isn't about reacting emotionally. It's about following a system, and knowing when to stop is just as powerful as knowing when to start. That one principle has protected me and helped me grow more than any hot stock pick ever could. But here's the thing, even with the right system, most beginner investors still make mistakes that sabotage their progress without even realizing it. And the top 5%, we avoid those mistakes like the plague. So if you want to take this to the next level and learn exactly what not to do so you can stay in the game and build real wealth, watch this video next. 5 stock market mistakes the top 5% of investors avoid. It will save you years of frustration.